Alright, hello everybody and welcome back to another episode with Sharp Education. This is not going to be expanding on the progression that we're doing into machine learning. I want to just take this code that we built in the last episode, regression anything.ipynb, and just play around with it a little bit more. I think it might have felt a little bit rushed. I don't like to make my videos longer than 20 to 30 minutes. So I didn't dive into the full threshold that this could do. I just sort of laid it out that it's flexible and left you guys there. So today I'm going to be doing some playing around a little bit. I'm not probably going to teach you anything new about regression or what this can do, but I'm pretty much just going to be playing around with what this code can result in and the way you can understand it. So if you're interested in just seeing a little bit more outputs, hearing people or hearing me speak in a quantitative manner, if you're just interested in being around the field of study like I am, then this episode's for you. It should only be about 10 minutes, 15 minutes maybe, of me taking some of our old indicators, building a regression analysis on it, checking some other tickers, and then showing what the results are. I'll try to edit out me pasting in the other indicators, but you know, it's going to be a slightly less informative episode, more exploratory, and I'll try to explain what we find in this output as clearly as I can. You might have noticed by now that I am not a teacher, but I am an understander, so I might be able to put my interpretation of statistics into words that make sense for you. Who knows? So let's just get started. We've done SPY on the 1 day. So I'm going to do 1 hour. And the truth is, I don't like fair value gaps. I think they're stupid. I don't think they mean anything. And I would never use them in a trading strategy on my own. So I'm just going to take them out. I think volume and the MACD histogram are both, as far as technical indicators go, a bit more, or as far as technical information goes, a bit more legitimate. So if we just restrict this to volume and the MACD histogram, and I'm gonna just get rid of all of our fair value gap information, and we can get rid of this too, and we can get rid of all of those from our main function. If we're just going to run a really simple regression analysis to start out, and I'm going to add indicator after indicator to eventually build somewhat of a complex one with the technical indicators that we've programmed. We have 4, so eventually I'm going to put all 4 in. And if we just run this, which I think should work based on how I've set up the code, I hope nothing goes wrong here. The aim of the game was for this to be very simple and intuitive for anybody to do their own exploratory analysis, but let's find out if that's the case. And it is. Great. We have a p-value of 0.5. Remember, we want 0.05. So we can assume that the model with a regression analysis on the hourly chart of volume and price movements in the MACD, between volume and the MACD, and then price movements 1 hour from now. Not super informative. That's the relationship between our predicted outcome, our greatest predicted price movement being 0.001%. And this is interesting. So the volume p-value is not significant, and the MACD histogram is almost as insignificant as it can possibly get. So this means that the relationship between the the relationship between the MACD histogram and close prices in the next period, so 1 hour from now, are extremely likely to have been randomly generated. There's a 25% chance that the volume was randomly encountered, and the constant isn't significant either. So this model, not useful. And the relationship that these two have with close price movements in the following hour, 1 hour from now, is not useful. But if we do the MACD histogram on a standalone basis, again, that's about as useless of a p-value as you can possibly get. So this model is not important. You would not really enjoy using the MACD histogram to try and predict close price movements at all. I wouldn't recommend doing that at all. This is effectively, for me, proof that there's no relationship between the MACD value and future price movements, 1 period, and we can do 3 periods, 5 periods, and I'm going to do 10 as well. As long as we pass all of our regression tests, you can just set that up to be anything you want. So 3 hours from now, the p-value becomes 0.6, so not exciting. Looks like we got some pretty hefty autocorrelation here. It's not what we want. And if we do even more autocorrelation, like 10 periods, yeah, we're going to get some significant autocorrelation. So the way I could fix this is by, instead of like fixing autocorrelation, so that what that means is like every error is somewhat representative of what the following error ends up being in our analysis. And the reason for this is when we're looking 10 hours ahead, there's 9 hours of overlap. So the errors are always going to be 90% similar, more or less, is the best way I can explain that. So if it's not actually 90% similar, but there's 9 periods of overlapping information. So the errors are going to have a lot of overlapping results. If that makes any sense at all, I hope it does. So you can't just change the period to be 1 or 3 or 10. What you would need to do is, instead of having each day be its own observation, you would need to take a new observation every 10 days. So what I would do is I would set it up to take every shift row of the data frame and conduct the study that way. That might be an interesting adjustment I make to fix autocorrelation. You know what? Let's do that. I'm going to do a fix autocorrelation function. So before the generate regression output, I'm going to define fix autocorrelation. The data frame is now going to equal dataframe.iloc. All rows and every column up until our shift. Our interval, my bad, interval, and then it's going to reset the index, and we're going to drop it. That should be everything I want. And then we're going to return the data frame. And now I'm going to print the number of rows we have originally, and then I'm also going to print the number of rows we have afterwards. Print data frame. So print len of the data frame, and then print len of the data frame as before we ran this function. And then we're going to return the data frame with the fix autocorrelation. So after we've added the target, after we've added our feature variables and the target variable, we want to add our fix autocorrelation function. Data frame is going to equal fix autocorrelation. Data frame equals fix autocorrelation to the data frame, and then run it. So, right, so we go from 5,086 rows to 509, which is a tenth. So if we're shifting 10 days in the future, we now have a tenth of the data to work with, but our autocorrelation plot is nice and clean. Isn't that so interesting? How once you understand the data you're working with and you understand the errors you're being given, you can also understand the steps you would need to take logically to fix them. So I know this was supposed to just be an exploratory thing, but we've also solved the problem. So congratulations if you stuck around just out of curiosity. You get the extra benefit of knowledge. Thank you for listening to me. So we're going to keep this in all of our functions now. So fix autocorrelation. This gets rid of autocorrelation when we shift multiple days, multiple periods, my bad. Now we can, instead of doing 10, but first let's take a look at what the 10 yielded. The F statistic was 0.8. That's no good. You can encounter this relationship randomly 80% of the time. So you don't want that. Distribution of residuals is normal looking. Great. So we passed all the tests and we've assumed effectively that there's no relationship between the MACD and 10-period price movements on the hourly interval. Just for shits and giggles, we are going to do 5 minutes. You can do 1 minute. And again, the reason I do daily is just because there's more data for daily, and if it doesn't work on the daily interval, I cannot guarantee anything. I can be fairly confident that it will not work on any other interval of your preference. And a lot of people like to point out my use of the daily interval as like lack of experience or understanding of what day traders do, but I'm explaining this as if you can't find a pattern in daily data, you're not going to find it in minutely data. That it's just a narrative that people tell themselves to make even more baseless decisions. So for some reason we've gone from we're still doing the 10-day look ahead or 10-minute, 50-minute look ahead, 10-period look ahead on the 5-minute candle. That is another randomly encounterable correlation because we have such a small sample size to work with now. If we do 3 minutes, is there a relationship between MACD and 3 minutes? No, this isn't looking good at all. 50% chance of getting that correlation randomly. Not what you want. So let's add some more indicators. We have the target and the MACD. Let's add the target after we add the features. Just for my sanity, I think that makes more sense. Adding the MACD, and then we are also going to add some other variables. Let's add the money flow index and the plot as well. Control C, Control V. And let's add the Bollinger Bands. Add Bollinger Bands. Control C, Control V. We also need the Bollinger Bands global variables. Control C, Control V. Cool. And then we're going to add those features to our main function. Data frame is going to add MFI to the data frame, and data frame is going to add Bollinger Bands to the data frame. Run everything, and whoops, I forgot to update our list of features. Strategy is now going to involve the MACD histogram, the money flow index, I think is just the name of the column. Yep, and we have data frame. So we can make another column within the Bollinger Bands for the close as a percentage of the difference between the upper and lower band. So let's run this just to check what our final data frame looks like. Here we go. So Bollinger Bands negative. Oh, yeah, because I just have one standard deviation. So this is normal. It can go above 1 or below 0. Let's do 2 standard deviations, which should encompass 95% of all values. So devs are going to be 2. Make this make more sense for me. Very small study. So we're never going to get statistical significance from a study as small as this with 23 rows. You need a larger sample size. So now we have all of the material necessary to conduct a regression analysis on Bollinger Bands, money flow index, and the MACD histogram on close prices, however many periods in the future we want, with no autocorrelation. Now let's do 5 periods from now on the 1 hourly chart. So can we place a 5-hour trade using these indicators and accurately forecast the close price movement as a percentage consistently enough over time, or at least at a statistically significant level. We need to increase the look back window to the maximum it can be. I keep that at 10,000. And the answer is no. These values aren't super helpful. So even when you hold the rest of the variables constant, the p-value for all of these technical indicators is really weak. So we have a 0.2, a 20% chance of randomly encountering the correlation coefficient provided for the MACD histogram. Even when you hold the rest of the technical indicators constant, you have a 40% chance of encountering that with the money flow index and a 75% chance with the Bollinger Bands. So there's not a strong argument for any of these technical indicators providing a statistically significant relationship with our price movements 5 hours from now. Now, our sample size, I think, is going to be pretty small because I divided it by 5. Oh, number of observations, 1,110. 1,010. Whoops. Okay, so even when we use all three of these, what if we add one more? Let's add the relative strength index, which is just a more simple form of the money flow index. Relative strength index is going to be 30. Good. So this is everything. We're going to add this to our final function. Data frame is going to add RSI to the data frame. And we're going to also include this in our strategy global variable. Run everything and get a full regression output for 4 technical indicators. No statistical significance across any of the indicators when the rest are held constant. The probability of the model is weak. I need to create a plot figure command. Just nothing. There's really nothing going on the S&P 500 for 4 technical indicators and price movements. I think we have 3 periods from now. We have 5 periods from now on the 1 hourly chart. We can do 3, see if there's anything there, and then we'll do 1 on the S&P 500 1 hourly. And then we'll change the tickers around for the 1 hourly. But as you can see by now, there's just an unlimited amount of tests you can run, things you can explore. And with an unlimited amount of tests comes a very limited amount of functional strategies. That is important. We're doing some complicated stuff, and it's becoming obvious that there's nothing simple happening. These strategies are not simple. These are elaborately tested, statistically proven to be inefficient. So it might look a little bit disappointing at first, where we're doing all of this complex stuff. We're putting in 5 technical indicators to our trading strategy. We're regressing it. We're doing everything right, and nothing exciting is happening. It might look disappointing at first, but I need it to be put in the perspective of, imagine how disappointing it would be if instead of understanding that it was wrong before you were trading, you thought it was right the whole time when you were just losing money. This could be a lot worse. So again, we're going to keep building on this and trying to find creative solutions to finding that one effective strategy, or maybe multiple, who knows. But this is the approach you should be taking. We have lost no money in understanding that these technical indicators, even when working in harmony, don't provide any value. We have lost no money at all, and we have learned so much. This is quantitative finance. Really fun stuff. If you have stuck around this long, you must find it at least remotely interesting as well. So I commend you. You are pretty much my friend. Let's do a couple other takers. Let's take Tesla, 1 hour in the future, all of our technical indicators, see if there's any relationship, see if these technical indicators mean anything at all on an hourly data frame. They don't. That p-value is not exciting. That correlation is randomly encounterable. Just useless, even when you use them in harmony. Maybe a couple hours in the future, what if we did 3? Could we say there's a relationship between our for technical indicators and future price movements. I think 3 hours from now is what we just put in. I'm forgetting already. A little bit lower of a p-value, but just look at this correlation here. You're not going to make money consistently, even if you're taking, for example, say all of these technical indicators agree, like MFI overbought, RSI overbought, Bollinger Bands overbought, and MACD overbought. So they're all agreeing. And even if you took that trade, the relationship you would have could scatter between any range here. You could not have any confidence in actually making money even when all of these are working together, because it's provable and it's shown right here. Not with any claims, not with me telling you like, oh, just pay $5,000 to understand better what your trading strategy is going to do, get your emotions in check. None of the bullshit. It is just right here, ladies and gentlemen. This stuff does not help. So we got to get funky with it. We got to start doing things that nobody else can do, or at least very few other people can do. This exploratory analysis was actually just a setup for me to start taking us in more creative directions. We're going to be doing some logistic regression in the next episode. I already told you about that. And we'll be trying eventually to start breaking these into training and test sets to see if we can make our first machine learning model that uses regression. And if you don't know what any of that means, that's okay. We're going to try and break it down as slow as I can, as effectively as I can. Again, I'm not a teacher, but I am an understander. And I will try to make all of this make sense as we continue moving forward. If you guys want me to test anything specifically that you don't think you can input yourself into this code, let me know in the comments. I know I go a little bit fast and sometimes I ramble a little bit, but I hope that the key takeaway from this exploratory analysis is clear. There's not a simple linear relationship or pattern that you're going to find. And the people who are trying to find that simple pattern that makes them money consistently for the rest of their lives are digging themselves into a very deep hole and then sometimes blaming themselves for that failure as well, which is why I started this channel. And it's good to know that I have a following now that is listening to what I'm saying and understanding the outputs from these analyses. So it feels really good. Thank you guys so much for the patience and the interest and the comments and the likes and everything. I look forward to building on the outputs from this code in the future episode. And until next time, stay sharp.